Across Europe, a new option is quietly appearing at checkout. Not pay with card, but pay directly from your bank. At first, it seems simple. Just another payment method, right? But behind that small button is something much bigger. A strategic shift that could challenge American financial dominance in a way we haven't seen since the euro was created. And the data shows it's moving faster than anyone expected. So what's really happening here? Welcome to Smart Card Europe, where we break down the systems shaping global finance. Today, in the Netherlands, Ideal handles more than 70% of online transactions. Visa and Mastercard are barely in the picture. In Sweden, about 85% of adults use Swish. In Spain, Bizum processes millions of payments every single day, with tens of millions of active users. These aren't small apps, they are direct bank-to-bank systems, moving money instantly from customer accounts to merchants. No card network in between, no extra fees, no dependence on US infrastructure. This model is known as A2A, account-to-account payments. But in practical terms, it represents financial independence, disguised as convenience. Now let's look at the scale. By 2024, A2A payments already accounted for around 17% of Europe's e-commerce value, and they're growing at nearly 30% every year. By 2026, the market is expected to cross 850 billion. Globally, A2A transactions could rise from 60 billion in 2024, almost 186 billion by 2029. That's massive growth in a very short time. You can call it a payment revolution or a strategic shift away from American dominance. Both descriptions fit. So how did Europe make this happen? The foundation was already in place. SEPA, the single euro payments area, has existed since 2008, making cross-border euro transfers easier and cheaper. Then in 2017, SEPA Instant was introduced. Suddenly, money could move in seconds, anytime, 24/7. At first, it didn't seem like a big deal, but everything changed between 2024 and 2025. The European Union made instant payments mandatory. Banks were required to receive instant transfers and soon after to send them as well. By 2026, instant payments became the standard across Europe. And just like that, Europe built a real-time payment network, completely independent of card systems. Now, when someone in Amsterdam pays a merchant in Berlin, the money moves instantly, bank to bank. No Visa, no Mastercard, no American processors. From a systems perspective, this is a major shift. Europe has effectively created a parallel financial network where US payment systems are no longer essential. But infrastructure is only part of the story. The real power lies in economics. In the United States, merchants typically pay between 1.5% and over 2% in card fees. In Europe, those fees were already capped, 0.2% for debit cards and 0.3% for credit cards. But A2A payments reduce costs even further, by 30% to 70%. So instead of paying €2 in fees on a €100 transaction, a merchant might pay just a 50 or even less native incentive. So naturally, businesses are encouraging customers to choose bank payments. They offer discounts, rewards, and faster checkout experiences. For users, it feels seamless. Just confirm the payment in your banking app. But behind the scenes, everything stays within European infrastructure. No US networks involved. Now let's talk about the current phase, consolidation. For years, Europe faced one major issue, fragmentation. Each country had its own system, Ideal, Swish, Bizum, and others. They worked well domestically, but not across borders. That's where Visa and Mastercard remained important. If you wanted to operate across Europe, cards were the only universal solution, but that's now changing. A new system called Wero, launched in 2024, is beginning to unify these national platforms. Backed by major European banks, it already serves tens of millions of users. Instead of replacing local systems immediately, Wero is gradually integrating them. For example, Ideal is transitioning into Wero, and over time, it will be fully absorbed. The same process is expected across multiple countries. By 2027, millions of users will be part of a single system. When you combine instant payments, lower costs, and cross-border functionality, you get a powerful outcome. European merchants can now accept payments from across the continent without relying on American networks. This isn't just removing intermediaries, it's a deliberate shift away from them, and it's happening quickly. Companies are merging and expanding A2A platforms, bringing millions of users together into unified ecosystems. The goal is simple: one system, one integration, one network for Europe. What makes this even more strategic is how it was done. Europe didn't ban US companies. Instead, it created a better alternative: faster payments, lower costs, mandatory participation, and then let the market decide. Now, Visa and Mastercard face a serious challenge. They can't compete on price. They can't match real-time speed. And they can't match universal bank coverage. In Europe, they're gradually losing relevance. And because this shift is framed as efficiency and consumer benefit, it's difficult to challenge politically. But the impact goes beyond payments. When transactions stay within Europe, data also stays within Europe. Funds settle in European banks, and valuable financial insights remain local. This reduces visibility for American institutions into European consumer behavior. Even more importantly, losing transaction volume means losing scale, and scale is critical in payment networks. As Europe strengthens its internal systems, US networks weaken globally. Looking ahead, by 2027, A2A payments could account for 30 to 35% of Europe's e-commerce. Card payments will still exist, but they may become secondary. And once merchants start prioritizing pay by bank as the default option, a powerful cycle begins. Fewer users choose cards, merchants reduce card visibility, and usage declines even further. We've seen this pattern before, with checks disappearing across Europe. Same strategy, much higher stakes. For Visa and Mastercard, Europe is no longer just a shrinking market, it's becoming structurally challenging. They can't increase fees, they can't beat instant speed, and they're competing against bank-owned systems. So the question now is, what happens next? Do they lower fees and reduce profits, focus on less regulated markets, or reposition themselves within A2A infrastructure? One thing is clear: this shift in Europe is not reversing. The infrastructure is in place, the incentives are aligned, and adoption is accelerating. And when control over payment systems is lost in a region of 450 million people, it's not just about transaction fees, it's about control of the financial system itself. And that changes everything. This is Smart Card Europe. Subscribe for more deep insights into the future of global finance.